When selling your business, there's going to be two piles of money. Pile A is going to be how much you get when you sell your business. Pile B is going to be how much you keep after taxes. Ideally, you want pile B to look as much like pile A as possible. I'm Arthur Petropoulos, managing partner and president here at Hillview Partners. We're a middle market, lower middle market investment banking firm, helping companies typically generating $1 million to about $20 million in pre-tax earnings or EBITDA to sell their companies or to secure capital. So you're going to sell your business. Someone is going to pay you a bunch of money at closing, perhaps some amount of money after closing through an earnout, a seller note, some other structure, and you're wondering to yourself, how do I keep as much of this as possible? What are the tax ramifications? What is actually going to land in my bank account? And so depending on what shape, form, or fashion the deal looks like, what types of payments you receive, what the timing of those payments received, what the structure of the deal is, these are all things that bake into it. And in today's video, we want to walk through a few simple rules of thumb to keep in mind when structuring and negotiating a deal to make sure you keep as much of the deal consideration as possible post-transaction. I will caveat, I do not have a CPA license. I am not an accountant. Ask your trusted CPA as to what their opinion is. These are just some things that we have seen after doing this many, many times. So to start, let's break it down into two major components. The first is going to be the consideration you get at closing. The second is going to be any consideration that comes after closing. So for the at closing amount, or what they call the cash at close consideration, it will heavily be dictated by two things. The first, the structure of the deal. The second, in a particular type of structure, the allocation of the deal. And so we'll get into the details here. But first, let's say structure. There are largely two types of ways to sell a business. The first is going to be a stock purchase. The second is going to be an asset purchase. In the situation of a stock purchase, you can think of your business as a box with a string on top of it. Someone else buys the shares, and they take the string, and they get the box and everything that comes with it. So in these situations, assuming that you've owned the shares longer than a year, which in 99.9% of situations is going to be the case, you are going to pay long-term capital gains treatment on the appreciated value of the shares over your basis, which presumably is going to be very little. So think of you sell your company and you're going to pay long-term capital gains, which at a federal level is around 20%, and state level is going to vary, but that's going to be the tax treatment. For an asset purchase, however, you can think of that structurally as instead of someone just taking the string and everything with it, they are kind of reaching into the box, taking the stuff out of it that they want, leaving everything else in there and replacing it with cash. And so you still retain the ownership of the entity or an entity, and they give you cash, they take the things out of it, and the tax treatment in a situation like that is going to depend on what they are paying for the different things that they're buying. Now you would say, well, isn't it just easier to sell shares? It certainly is. Well, why don't I just do that? Well, that would be the case. However, in about 95% of transactions under $100 million, it's going to be an asset purchase. And the reason being is if an acquirer can just buy certain things and leave everything else, they are by definition leaving any lingering liability. It prevents a lot of legal risk on a post-transaction basis for a buyer. Now again, if there's not any legal risk, it's not going to make a difference for the seller. However, this is a big cost consideration for larger companies making smaller acquisitions, and it's just generally been the way deals have been done in this size range since, before I had a receding hairline. So that being said, in an asset purchase, which is going to be likely the structure in which you see it, for the cash at close situation, there's going to be a part of diligence where there's what's called a purchase price allocation. And so this can either be proffered or proposed by the buyer or the seller. A lot of times it's put together by the seller's accountant, but in some cases the buyer offers it first. But in any event, you can think of it as an allocation of the purchase price. We are going to buy the company for X dollars, but the breakdown of it from an asset allocation is we're paying X dollars for the inventory, Y dollars for the equipment, Z dollars for the goodwill, or basically all of the value we're paying beyond just the inventory and the equipment. And so each of these is going to have different tax treatment. Inventory does not have any taxes paid on it. So if you already paid for inventory and you are selling your company, whatever amount that's allocated to the inventory is not going to be taxed. The equipment, or the FF&E, as they say, furniture, fixture, and equipment, that is going to be taxed at ordinary income. However, when you have equipment in a company, that is going to be depreciated every year. So the actual ordinary income tax is going to be paid on the difference of your depreciated basis in those assets and what someone pays to them. And then lastly, the goodwill, or everything else paid for the company, is going to have a long-term capital gains treatment, similar to if you were to have a share sale. So in a situation where you're selling the business, what you want to do is obviously maximize inventory value allocation, minimize FF&E allocation to the extent possible, and maximize everything else towards goodwill. And the blended rate of that should approximate a share sale if structured correctly. Again, there's different reasons why different parties may want to value things differently from a buyer side of things, but as the seller, you need to work with your accountant and your banker to make sure that that allocation is as advantageous to you as possible. So that is the, call it cash at close consideration. If it's a share sale, it's going to be long-term capital gains treatment. If it's an asset sale, it's going to be dependent on the allocation, inventory tax-free, FF&E, ordinary income, goodwill, long-term capital gains, again, presumably over a year. Now, one mistake not to make is if you're thinking about selling your business in the next couple of years or in the next year, don't change the structure of the company, because that can sometimes restart that one-year clock and it can make things a little bit tricky. So if you're an LLC, instead of changing to an S Corp, just stay an LLC, but report your taxes as an S Corp, which is an election that you can make. And so things to think about if that's a near-term horizon for a decision. Now, getting into the post-transaction items, a lot of times when people buy companies, they're going to buy 80% of the business, 90% of the business, and then 10% of it's going to be, you can roll your equity into the new venture that we have. You can take a seller note to be paid over a certain amount of time, or you can have an earnout, in which case certain things have to happen and you will get more money. Or there's other things that can be like consulting agreements or profit shares, things like that. The general way we like to think about things is if something is a seller note, the seller note component is going to be considered basically a loan or part and parcel of the purchase price. So it should have a long-term capital gains treatment on the receipt of the payment of the principal over time. Now, buyers don't necessarily like seller notes because from a tax write-off perspective for the buyer, they are not going to be able to expense the principal payments for the loan. Now, they will be able to expense the interest payments, but the principal payments is going to be a large chunk of it. So they don't like that. So a lot of times they'll say, well, it should be an earnout, it should be a profit share, it should be a consulting agreement. So basically something where we are going to just pay you over time, kind of in chunks. And so sellers will say, well, I'd prefer to have a note. It's a lot simpler. Buyers will say, well, I'd like to pay you over time in some sort of consulting agreement. And the challenge with that is that as the recipient or the seller, that's going to have ordinary income because it's basically going to be like almost like a salary, whereas the buyer can expense it. Now, what's the happy middle ground on these things sometimes is keeping an entity, right? So if you sell the business in an asset sale, you're going to have the entity. Now, whether you use that entity or you create another one, you would have, call it post-transaction LLC. All of the payments that are happening after the transaction go into the LLC, and then you have the opportunity to expense stuff against it. Now, if you're traveling, eating, paying for a Ferrari, whatever it is, right? There's things that are business related, quasi-business related, that can be expensed against the income coming in, and you can defray some of that income. And you can defray the tax liability on some of that income. And what that allows sometimes is that if the buyer can expense the payment, they can afford to pay more. And if you can shield some of that income on your side, then you can pay effectively a lower tax despite it being taxed on an ordinary income because you're just applying that ordinary income to a lesser amount. And so these are the considerations on a transaction relative to taxes to ensure that you keep as much as you can. As one of our clients had once said to us, Uncle Sam is a relative, but we like to keep him a distant one. And anytime you sell a business, you really want to make sure you keep as much as you can. So if it's going to be a stock sale, great, nice and simple. If it's going to be an asset sale, allocate effectively, allocate advantageously, and that's part of the negotiating. We always say during the diligence process, there's three things you're really going to negotiate: the working capital, the transition for ownership, and the purchase price allocation. Purchase price allocation has a big tax implication. And then for everything post-transaction, we'd say try to keep it in the long-term capital gains bucket via seller notes, via earnouts, in the sense of maybe some sort of rolled equity that gets liquidated in the future because you're going to own it for a long period of time. There's some uncertainty to it. But to the extent post-transaction you have to get stuff in real time, whether it's an earnout, whether it's a more kind of structured earnout in terms of guaranteed payments, in terms of consulting agreements, things of that nature, always try to keep an entity that you can offset expenses against the income that's coming in. I mean, I think as just a general rule, you've been in business for a long time. If you sell your company, just create an entity, call it Consulting LLC, and the world's not going to know how good or bad of a consultant you are, but if you've run a business for 30 years and now you're going to be a consultant for 10 until you retire or into retirement, if you lose $250,000 a year because that's kind of your expenses to live life, and it offsets a bunch of income that you have either from the post-transaction or even just more broadly or globally from income that you're getting off of investments or whatever it is, like no one's going to come. Again, let's put the disclaimer at the bottom. We are not the CPA, but that's not going to be something that's heavily scrutinized. And so from our perspective, be smart about taxes when it comes to transactions. You want to make sure that you structure things intelligently such that you can retain, such that pile B can look as much like pile A as possible. You're not going to be able to be completely unscathed. However, if done correctly, it can make a significant difference, particularly when you're addressing larger numbers. And so while this week's video may not be nearly as entertaining as last week's soliloquy about my distaste for Taylor Swift, it will be considerably, perhaps even more pragmatic and helpful as you're thinking about selling your business. So that's the thought for today. Hope the week's going well for everyone. Keep pushing forward. God bless. We'll see everyone next time.